Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
And good morning. Yeah, look, today we're trying to connect some seemingly really contradictory dots for you.
Definitely seems that way. We've got massive political upheaval, right? Japan's got a new potential leader. France is in crisis.
And the U.S. government shutdown just keeps dragging on into another week.
Right, all that disruption. But then you look at the markets.
And they're hitting record highs. It's paradoxical.
Yeah.
Equities, safe havens like gold, even crypto, everything's up.
So that's the core puzzle, isn't it? How is all this instability, this political chaos actually fueling markets instead of dampening them?
That's exactly what we need to unpack. Let's start with that first big shock wave from over the weekend. Japan.
Huge news out of Japan. Sana Takeichi, a staunch conservative, won the LDP leadership race. As CNBC Asia Markets first reported, this positions her to possibly be Japan's first female PM.
And the market reaction? Instantaneous? Pure stimulus optimism, it looks like.
How so?
Well, Japan's Nikkei at 225. It jumped over 4%, hit a new record high, closing up there near 48,000. That was from CNBC.
Wow, okay.
And at the same time, the yen weakened a lot. Over 1.8%, pushed past that, key psychological 150 level against the dollar.
Okay, but electing someone seen as pro-stimulus, I mean, she's associated with Abenomics, pushing for a high-pressure economy, right? Isn't that a bit risky globally right now, with inflation fears still around?
That's exactly the global spillover effect that Goldman Sachs flagged in a note this morning. The expectation is, yes, more BOJ easing, more fiscal push.
And that means?
It means rising volatility in long-end Japanese government bonds.
KGBs.
Goldman Strategists basically said Japan is currently a net exporter of bearish shocks onto global long rates.
Okay, exporter of bearish shocks. What does that actually mean for, say, U.S. borrowing costs for you listening?
It means trouble in Tokyo doesn't stay in Tokyo.
Yeah.
Goldman estimates that a typical JGB shock adds about 2 to 3 basis points of upward pressure on U.S. Treasury yields. Same for German bond, UK gilts.
So not huge, but noticeable.
Exactly. And Bloomberg noted Japan's 40-year yield jumped, I think, 17 basis points at one point. That kind of move ripples out. It makes mortgages, corporate debt, everything potentially a bit more expensive globally. Japan's instability matters.
And speaking of instability, let's jump over to Europe. France.
Right. A sudden resignation. Prime Minister Lecornu is out, tied to this long-running political crisis they've been having.
And the market reaction there, not stimulus optimism, I take it?
No, quite the opposite. Bloomberg reported French markets tumbled. The CAC 40 index sank 2%. French banks got hit hardest. Société Crédit Agricole, BNP Paribas, all down significantly.
What about their bonds?
That's the key signal, really. French 10-year bond yields jumped. The spread, the premium over safer German debt, it hit the highest level this year.
That spread widening, that's always the canary in the coal mine for Eurozone stress, isn't it?
Absolutely. It tells you investors are demanding more compensation for holding French debt because of that heightened political risk. And predictably, the euro weakened too, down about 0.7% against the dollar.
Okay, so Japan, stimulus hopes push stocks up. France, political chaos pushes stocks down. And then there's the U.S.
Which seems to be playing by completely different rules. As Yahoo Finance pointed out, the government shutdown rolls into a new week. Key data, like the jobs report, is getting delayed.
Right. Total gridlock in Washington, but equities.
New record highs. The S&P 500 closed Friday at 6,715.79. It's remarkable.
How do you even explain that? One strategist, I think, from Interactive Brokers called it market nihilism. What does that even mean?
It's this idea that investors have just stopped caring about the shutdown, or maybe they even see it as a positive. Like, gridlock means no new regulations, no sudden policy shifts, maybe even delays Fed action.
That seems counterintuitive. The shutdown has real consequences. Kevin Hassett, the White House economic advisor, warned layoffs for federal workers could start soon if talks go nowhere. That was on CNBC. Democrats are holding firm on healthcare stuff.
It does have real consequences.
Yeah.
But the market, for now, seems laser-focused elsewhere. Or perhaps focused on getting out of the traditional system.
Okay. So if the political system looks shaky, if the value of the dollar feels uncertain, where does the money go?
Exactly. It leads right into what people are calling the debasement trade.
Yeah.
Basically, a flight from fiat currency uncertainty.
Into?
Well, classics, for one. Gold surged again. Bloomberg had it nearing $4,000 an ounce, topping $3,945. That's a 7-week rally now.
Okay, gold makes sense as a safe haven, but it's not just gold, is it?
not even close. Look at Bitcoin. It set another record high over the weekend, climbed up over $125,000.
$125,000.
Yeah. And Bloomberg linked that surge, partly, to the ongoing government shutdown. Investors just seem desperate for assets outside government control. And you see it in the options market, too. Very bullish sentiment, over 60% of open interest in calls.
And it's broader than just crypto, other metals too.
Absolutely. Yahoo Finance highlighted this. Silver is up, 49% year to date? Platinum's up 65%. It's a widespread move into hard assets and alternative stores of value. A real lack of faith in the traditional system right now.
So while money flees fiat, where's the next wave of investment going? Seems like technology, particularly AI, is driving massive shifts.
Huge shifts in talent, in infrastructure, everywhere. Let's start with talent. Reuters reported on World Quant's big competition, their International Quant Championship.
Right, I saw that. Record participation.
Doubled from last year, 80,000 university participants. The founder, Igor Tulchitsky, said AI and these large language models are actually lowering the barrier to entry for building quant trading models.
So more people can do it.
Potentially. He noted a rise in, single-person teams using AI agents to automate research and simulations. It raises questions, though. Is AI democratizing quant finance or just making the human quants focus on higher-level stuff? Or maybe both.
Interesting. But all this AI, all these models, they need power. Lots of it.
An incredible amount. Which leads us to the next big story. The energy crunch driven by big tech data centers. Google, Amazon, Microsoft. Their AI workloads are straining the grid.
And the solution being talked about is nuclear.
Specifically, small modular reactors. SMR CNBC had a good piece on this. These are smaller, maybe 300 megawatts or less, factory-built units. The idea is they're faster, cheaper, and safer to deploy, often right near the data centers that need the power.
And this isn't just theoretical, right? Projects are happening.
Oh, yeah. Michigan's Palisades plant is being restarted, and they're adding 2 SMRs on site. Microsoft actually signed a deal to buy power from the recommissioned 3 Mile Island plant. And Bill Gates' company, TerraPower, is building a next-gen plant out in Wyoming.
So the momentum is there, but are there risks?
Hurdles, definitely. That same CNBC piece offered a balanced view. The insurance industry apparently sees the engineering risk as low now, but academics, they warn widespread deployment in the next, say, 5-10 years is tough.
Why?
Well, regulations haven't really caught up with the SMR technology yet. There's always the risk of cost overruns. They mentioned an SMR project in Idaho that got canceled for that reason. And, public trust is still a big factor for anything nuclear.
Okay, so AI needs power. Power needs new infrastructure. And that infrastructure push is also hitting geopolitical walls, like in India.
Yeah, that's another angle from CNBC. U.S. tech firms are apparently hitting pause on leasing massive new data centers in India.
Why the delay?
Trade uncertainty, basically. They cited recent U.S. tariffs on Indian goods, some up to 50%, and also this new $100,000 fee for H-1B visas. So the deals are on hold, maybe for 3-6 months. The tariff risk just makes big commitments tricky right now.
And friction with the U.S. seems to be pushing Chinese tech elsewhere, like Europe.
Exactly. Reuters reported on this. Chinese self-driving car companies, names like QCraft, Momenta, Deeproot.ai, they're kind of blocked from the U.S. market over data security concerns.
National security.
Right.
Yeah.
So they're accelerating their push into Europe. They see it as, quote, a more open environment. Momenta, for instance, is teaming up with Uber to test Level 4 driverless tech in Germany next year. They're trying to grab market share there since the U.S. door is, pretty much closed to them.
Okay, so we have these huge macro shifts. Political, technological, geopolitical. But there are also fundamental changes brewing within the financial system itself, like this fight over company reporting.
Yeah, this is potentially huge.
Yeah.
The SEC is actually pursuing a rule change, something President Trump requested that could end mandatory quarterly reporting, the Form 10Q filings.
End quarterly reporting, so companies would report less often.
Potentially, yeah. They might switch to semi-annual reports instead.
That sounds like it would save companies a ton of money and hassle.
Oh, absolutely. Estimates range from $50,000 to over $1 million per filing saved. But guess who stands to lose?
Let me guess. The auditors.
Bingo. CNBC highlighted this. The big 4 accounting firms, Deloitte, EY, KPMG, PwC, could lose something like 15% of their audit fees if 10Qs go away.
That's fascinating because didn't they used to argue for quarterly reporting, saying it reduces risk for investors, provides timely info?
They did. So now you have this battle. The firms fighting to keep the system that benefits them, while proponents say dropping 10Qs saves costs, and might even encourage more private companies to go public. It seems like it has a real, maybe 50-50 chance of
A
happening.
fundamental shift. And that's happening just as another fundamental shift is gathering steam, tokenization.
Right, this is the intersection of Wall Street and crypto, really.
Mm.
Moving towards tokenized stocks. Basically, digital versions of shares, think Tesla, NVIDIA, trading directly on a blockchain.
And the potential market size here is staggering, isn't it?
It really is. Boston Consulting Group and Ripple put out analysis suggesting the market for tokenized real-world assets could grow from around $600 billion now, in 2025, to nearly $19 trillion by 2033.
19 trillion. Wow. What's the big appeal?
The main things are 247 trading markets that never close and near instant settlement. No more waiting T+2 days for trades to clear. Nasdaq's already proposed listing tokenized securities. The tech is moving fast.
But what's the roadblock? If the tech is there and the demand is potentially huge.
Regulation, as usual. Wide adoption, especially here in the U.S., really needs a proper, comprehensive regulatory framework. Right now, these products are kind of being handled case by case, ad hoc. Until that clarity comes, it probably won't reach that multi-trillion-dollar potential. But the pressure is building.
Okay, we have covered a lot of ground today. We went from Japan's stimulus shockwave and France's political woes to this bizarre resilience in U.S. markets despite the shutdown. Then the huge impact of AI on talent and the grid, sparking a nuclear comeback, the trade frictions, and finally, these fundamental shifts in reporting and how assets might trade.
It's a whirlwind. But the central theme, the provocative thought maybe for you to take away, is this. We're seeing a U.S. government shutdown seemingly boost both stocks and traditional safe havens to record highs. We're seeing bedrock financial pillars like quarterly reporting and traditional stock trading facing potentially existential change from regulators and technology like tokenization.
So the question is,
Does political uncertainty even suppress markets anymore? Or has it somehow become a catalyst, a driver forcing incredibly rapid technological and financial mutation, maybe faster than we've ever seen before?
That is definitely something to chew on. A lot happening out there. We'll see you all tomorrow morning with new headlines from major financial magazines.